In February 2026, global peace negotiations collapsed. The immediate fallout was the closure of key global shipping lanes, including the Strait of Hormuz, triggering an aggressive worldwide energy supply shock. Human analysts were still reading the breaking news headlines when the market reacted. Algorithmic high-frequency trading systems, supercomputers designed to act without human intervention, ingested the geopolitical data, recalculated their macroeconomic risk models, and executed thousands of sell orders. All of this occurred in less than 400 milliseconds. The speed of that automated sell-off created a sudden vacuum in market liquidity. Everyday, manual retail investors woke up hours later to find that their leveraged positions had fallen through that air pocket, triggering mechanical liquidation protocols that completely wiped out their portfolios. This technological gap has split the 2026 market into two tiers. On one side, institutional whales operate with sub-second execution speeds. On the other, retail participants are forced to trade against news that has already been fully digested and priced in by machines. When speed is the primary variable for profit, a human manual trade is a structural liability. In this ecosystem, any portfolio managed by human intuition alone is effectively a source of liquidity for automation. To understand why these algorithms are hunting retail capital, we have to look at the broader macroeconomic picture of April 2026. Sticky global inflation and surging overseas yields have forced the Federal Reserve to hold interest rates higher for much longer than the market anticipated. Facing this prolonged high-rate environment, institutional whales are quietly executing the Great Pivot. They are systematically draining their capital out of the highly speculative, overvalued tech assets that dominated the 2025 AI bubble. Institutional liquidity is rotating back into the old economy, sectors like industrials, materials, and consumer staples. These companies provide physical infrastructure and margin stability, offering a reliable hedge against persistent inflation. At the same time, institutional capital is aggressively reinforcing its positions in highly regulated safe haven assets. Gold has experienced a massive, sustained bull run, establishing a new elevated trading range supported by continuous central bank accumulation. This massive pivot creates a mechanical problem. These large institutions are holding billions of dollars in overvalued tech stocks and volatile digital tokens. If they dump those assets onto the open market all at once, the price will crash before they can successfully exit. To safely protect their capital, they need to manufacture their own exit liquidity. They need a wave of misinformed retail investors to eagerly buy the exact assets the institutions are quietly preparing to abandon. To build this trap, malicious actors spent years reverse engineering the massive meme stock short squeezes of 2021. They learned exactly how to weaponize the fear of missing out, or FOMO, and mimic the appearance of decentralized coordination. One method is AI washing. In early 2026, an eco-friendly sneaker brand abruptly announced it was transitioning into an AI infrastructure business. Retail algorithms detected the buzzword, triggering a massive influx of capital that pushed the share price up nearly five-fold in a single day, regardless of the company's actual technological capabilities. On encrypted messaging platforms, organized syndicates take this deception further. They deploy generative artificial intelligence to create deepfakes, synthetic voice clones that mimic Wall Street analysts. Using stolen corporate branding, these fake advisors build absolute trust over several weeks before urging retail participants to dump their savings into an obscure, doomed asset. In the unregulated cryptocurrency space, the primary tool of manipulation is wash trading. This occurs when a single operator controls two different digital wallets and trades the exact same asset back and forth to itself. Automated smart contracts execute these wash trades hundreds of times a second. When retail investors look at public tracking sites, they see massive volume and organic market frenzy. Believing the asset has incredible momentum, the retail capital is injected to buy in at the absolute peak. The second that fresh retail money is absorbed, the trap snaps shut. The operators turn off their trading bots. The fake volume immediately evaporates, exposing the asset as completely illiquid, and the price collapses instantly. By combining AI-driven psychological manipulation with mechanical volume spoofing, large capital holders easily and systematically extract wealth directly from everyday investors. Recognizing this extreme vulnerability, global regulatory bodies launched a coordinated counterattack throughout 2025 and 2026, actively compressing the operational dark spaces where these syndicates hide. The European Union implemented the Markets in Crypto Assets, or MiCA, framework. With a hard enforcement deadline, MiCA eradicated the ability of fraudulent exchanges to hop between lenient borders, establishing a unified regime that classifies wash trading as a highly punishable offense. The SEC is now prioritizing individual liability. Their enforcement teams are directly charging the specific executives who orchestrate deceptive AI washing narratives, fundamentally changing the risk-reward calculus for those attempting to pump their stock valuations. These legal frameworks are aggressive, but they are also reactive. Fines are levied and operating licenses revoked only after the manipulation has occurred, doing nothing to recover the savings an individual has already lost. To survive in 2026, retail investors cannot wait for regulators to save them. They are abandoning emotional guesswork entirely and adopting the exact same technologies used by the institutional whales. The first layer of the fence is on-chain forensics. Because public blockchains record every transaction, retail investors can use tracking software to watch massive institutional capital move in real time. By seeing the capital flow before the trade executes, retail participants neutralize Wall Street's traditional data advantage. To guard against manipulated volume, the retail sector applies mathematical rarity coefficients. Instead of buying into aesthetic hype, investors use statistical models to demand verifiable, functional utility from digital assets. If the asset lacks measurable value, a shield deflects it, starving manipulators of their exit liquidity. The ultimate countermeasure is the deployment of personal AI trading assistants. These deep learning models ingest global news sentiment, parse corporate filings, and execute automated defensive hedging at speeds that match the high-frequency algorithms. By handing execution over to these intelligent systems, retail traders insulate their portfolios from the human vulnerabilities of fear, greed, and the sunk cost fallacy. The pump and dump scheme persists, but for the individual investor in 2026, survival depends on adopting algorithmic discipline. To stay in the game, you have to defend yourself with the same machine logic used by the predators.